Good morning, everybody, and welcome to Equites Property Fund Financial Year-End Results for February 2021. We welcome you all today, and unfortunately, we're not with you again this year, and we really do look forward to the day where we can share a cup of coffee before the presentation and have a chat. It's not to be. Fortunately, the world is making some positive progress at the moment, and hopefully it will play out lovely. Let me start with what we're going to be talking about today. So I'm going to start with a little bit on the strategy, a quick review of the high-level numbers, and then I'll talk a little bit to the trends, both in SA and in the UK, and then sort of close out with a little bit on our developments that we've executed on, and then we'll be handing over to Riaan. Riaan will take us through some of the detail of our fundamentals. I suppose, you know, the bedrock of why we can give you these numbers. Leila will then come in after Riaan and give us an update on finance, treasury, and then ESG, which is becoming a really important sector within the Equites framework. We then have the pleasure of having our Newlands joint venture partners in the UK joining us. We obviously are looking forward to the day when they will be in SA with us and they can present live to you all, and we can meet them too. And they will basically take us through what's happening in the UK in our joint venture, but also give us a little bit of oversight too. I'll come back at the end and talk through you know, the prospects and also, you know, what we see coming forward in the year ahead, if you like. So let's start with our strategy. And I have the pleasure of obviously saying again that we've been boringly consistent in this. And you know, the Equites strategy, and has been for many years now, is really focused on becoming a globally relevant REIT, specializing in the logistics sector. We've got a single-minded focus on this, and you'll see through the presentation, you know, all the sectors of it will talk back to this single-mindedness. The one thing, obviously, that gives us great pleasure today is we've spoken over the last 4 or 5 years in presentations that we've got this high-quality portfolio of great assets with fantastic covenants. The wonderful thing that we have witnessed in the last year is that everything, all the rhetoric, if you like, everything that we've put out there and wanted you to believe, that basically has been proven correct. The portfolio has proven to be extremely resilient. The sector has been outstandingly positive, and consequently, we have been as high quality as we possibly could have been. So let's talk about, you know, what we're up to. So within South Africa, we're going to carry on looking to develop best-in-class logistics parks on key strategic pieces of land, and over and above that, we're looking to also develop just straight-up A-grade facilities. A lot of our parks are Joburg-based, and in Cape Town, a little less so, as well as in Durban. We'll continue to look for acquisition of assets. Obviously, these assets do need to match our exacting standards. We do look to bring things into our portfolio that will stand the test of time. And then the final element is we're constantly talking to various people in the marketplace, and we're looking to do sale and leasebacks with some high-quality covenants in high-quality buildings. In the UK, obviously, we carry on looking to unlock the key tracts of land that we've secured through optionalities and taking through zoning processes, and that will obviously be through our joint venture with the Newlands team, and they'll talk in more detail to that later in the presentation. As for acquisitions of portfolios or assets in the UK, I mean, we're constantly looking. The reality, and as we go through the presentation, you'll see it, the reality of it is that the market in the UK at the moment is extremely, extremely hot, and at current levels, it would probably be very difficult for Equites to make a meaningful return for our shareholders if we were to acquire at some of the pricing levels. So let's have a look at the year, just a quick review. I mean, the first one, obviously, that we're really, really pleased about is the 2.4% distribution growth. It's been a challenging year for the entire sector. It's been a challenging year for us too. I think, going back to what I said earlier, the portfolio has behaved really, really well, and the team has worked extremely, extremely hard to bring these results out today. In terms of NAV, we're slightly down on NAV, and Layla will talk to a bit more of that into detail a bit later on in the presentation. And our loan to value remains extremely conservative, and sort of as a consequence also of the size of our portfolio now being almost 20 billion, the scope for us to still execute on our pipeline is ample. Obviously, one of the most pleasing things is the weighted average lease expiry profile, and that's fantastic at 15.4 years, I believe, within the South African sector bears no equal. So wonderful, wonderful overview, and very proud to be showing you these numbers. So what have we done in the last year? So the first one, obviously, is we bedded down the Shoprite transaction. I mean, from commencement of negotiations to closing out, that transaction took well over a year, but we're very pleased to have bedded that transaction down. And as a consequence of that, we have created a fantastic joint venture with Shoprite, and we hope to execute on significantly more opportunities with them in the years ahead. In terms of that new developments, we've signed two fantastic developments with Amazon and Hermes in the UK. Hermes, not the clothing brand, but the German parcel delivery company, for a capital value of about 113 million pounds. And the Newlands team will talk more detail on that a bit later on. We've got some completed developments. Obviously, the DHL in Leeds was completed during the year. We completed Digistics, we completed Imperial, and we completed Ultron, all three in Johannesburg. And we did complete also some upgrades on some of our buildings, but combination of that has been sort of well over sort of 600 million rand worth of new product coming onto our balance sheet. In terms of our funding, we've had a fantastic year. The finance team have really bedded down the policy in terms of the frameworks, in terms of hedging, in terms of ability to raise at really attractive pricing levels, and obviously the feather in the cap for the year has got to be the ESG-linked debt facility that we've achieved with Standard Bank on a 1.5 billion rand facility, which obviously has been extremely well received by the market, but I think also it really talks to us as an organisation and what we mean and what we stand for. And then the final element that was sort of pretty significant in our world was we took the decision to sell two of our early acquisitions in the UK market, the two assets in Stoke, for a combined value of 43 million pounds, which we sold to Blackstone, and more importantly, we sold them a 6% premium to our book value, but a substantial premium to what we paid for them when we did acquire them. So that money obviously will be recycled into the UK development pipeline, and the promising thing is that obviously the fair value uplifts that we will benefit from going forward will deliver significant value to our shareholders. In terms of our performance, I mean, we won't harp too long. Obviously, we're very proud of the fact that we have been one of the standout organisations within the South African context, and our performance against the SAPI has been great. The second graph on this page obviously talks to a metric that we haven't really spoken to historically, and I think it's something that we believe we're going to start bringing into our presentations a lot more. And this is also as a consequence of some of the shareholder engagements we've had in the last year, where a total return metric was something that was deemed to be more appropriate than just a sort of single-minded distribution metric only. The consequence of that is that going forward as a team, and the way we invest and the metrics that need to be ticked off before we make a decision to move forward, either with a development and acquisition to add to our portfolio, and sometimes also a disposal, would need to feed into the combined metric of both distribution growth and also NAV growth. Obviously, this year there is a little bit of negative NAV growth, but we are predicting some positive stuff going forward, and we'll talk to that later in the presentation. Logistics sector. So, the last year has really been an unbelievable year for the logistics sector worldwide. I mean, the lockdown has really facilitated and helped drive a process of the e-commerce world to everybody. A lot of people that maybe were skeptical of using it or uncomfortable with using the internet to make certain acquisitions have almost been forced to go there. And I think a lot of people have been surprised by the simplicity and the speed at which goods can be brought to them in the comfort of their own home. Now, we're social beings, so we have no expectation that e-commerce is going to take over the whole world. Retail is certainly not dead. It will need to reinvent itself, no doubt, and the more able people in that sector of the market will do outstanding jobs. The benefit that we've had, obviously, is that every single retailer in the world and every single e-commerce platform in the world has now got to look at their real estate decision-making as a consequence of the push on e-commerce. So it has been fundamental. Within the UK, obviously, we've got the added issue around Brexit, which is going to result in border processes being slightly longer. And the consequence of that is that, stock holdings and onshoring is probably going to become a lot more marked in the years to come. The one thing that we have noticed in the UK, obviously, is that the average size of warehouse units have got slightly larger. So we're looking at sort of north of 300,000 square foot, which within SA terms is probably north of 30,000 square meters plus minus. And then the other thing which has really grown in demand has been the last mile delivery platforms. And the one thing about those platforms is obviously they're extremely land hungry. The consequence of both those two things is that bigger parcels of land are required to execute on these things, and the bigger parcels of land come with a pretty significant level of scarcity. And the Newlands team will talk to it a bit later on in the presentation, but that essence of controlling fundamental parcels of land in the right locations where we can deliver on these things will put us in a really strong position in the years to come. Over and above that, on the second slide here, basically looks at the take-up in the last year. And what we can see is that last year was an absolute record year in the UK, north of 50 million square foot of take-up. The expectation from all our interaction with the Chartered Surveyor Network in the UK is that this year will, in all likelihood, break last year's record. And the consequence of that is that, we will benefit from our portion of that demand. And again, the Newlands team will talk to that in more detail. The one thing that's quite interesting here, in the small print underneath that, you'll see that Amazon were 25% of that take-up last year. And a lot of people will say, yeah, but what happens when Amazon goes away? The reality of it is, and again, this is a personal opinion, the reality of it is that if you want to compete with Amazon, you're going to have to also start taking up. And I think what Amazon's going to do is going to force a lot of players that may have taken a lot longer to come to market with demands to have to come to the market. Otherwise, they're going to start losing market share. And all of this speaks volumes for what we can deliver into in the years to come. So very excited about what's going to happen there. In terms of how the sector has changed, the sector has become the darling sector. And if we look at some of these transactions up here, obviously the standout, it actually only closed about 10 days ago, is the top one is an Amazon building in Hinckley, which is in the Golden Triangle in the UK, in the Midlands. And as you can see, Aberdeen Standard basically have acquired this at a 3.1% yield. Now, these are pricing levels that have never been seen in this sector before. And the talk on the street from our interactions with the network is that they're going to be here for a while, and long-dated income has become extremely important to a lot of investment funds. You'll see another one with 15.6 years to Sainsbury's in Bedford, 3.5%, and another Sainsbury's a bit further down with only 12.5 years going at 3.87%. The rumor in the market, and again, it's rumor, is that the buyer of that bought it with a view of looking to re-gear that with a tenant. The consequence of that is obviously that monies will change hands if there is a re-gear, and if it becomes a 20-year lease, that will be reflective of probably a very similar pricing to the Amazon in Hinckley. In terms of SA, I think it's been a really interesting year in SA. I mean, let's start with obviously interesting outcomes like Mr. Price buying Yuppie Chef. I think not only have they bought something to feed into their homeware business, but I think they've also bought a platform that works extremely efficiently and well within the South African context. And over and above that, we have the global online company Wish, San Francisco based, that have gone into a partnership with the South African Post Service to ensure that the delivery of their products in SA basically are expedited. The JD Group has launched Every Shop, and it'll be interesting to see how they start competing with Takealot in the years to come. What's interesting is obviously the South African Express Parcel Association, the numbers that they've published, and we've seen the volume and the quantum of business that they're doing rising from 12 billion in 2012 to basically 20 billion in 2020. And we don't foresee that number sort of shrinking anytime soon. If anything, it's just going to carry on growing for the foreseeable future. Imperial acquired Parcel Ninja, so they're also wanting to go into that last mile delivery platform. And that space, I think, is going to become fairly competitive. And whoever finds the solutions, the cleverest solutions to ensure that they can get product to the consumer as quickly as possible, as efficiently as possible, and as cheaply as possible, will be the winner at the end of the day. And then finally, obviously, the retailers. I mean, if we look at their numbers in the last sort of 6 months that they've published, all of them have seen massively robust numbers, across the board, from ShopRite, Pick n Pay, TFG, Mr. Price, Dis-Chem, Clicks, just to mention some of them. But they've all got, if not high, very, very high double digits, some of them have got triple digit increases in terms of those volumes. In terms of the property availability for these operators to work in, what you'll see is across the sector, I mean, the one sector of the market which is obviously got the least vacancy is the high quality distribution warehouses at 2.3%. And combined with that, it's the only sort of sector of the property market which has shown a minute growth in rentals. To be totally frank, you're probably fairly flat there. And with inflationary pressures that could come through in the next year or two, it'll be interesting to see how rental growth sort of starts coming back into the market in the years to come. In terms of our developments, as I said earlier, we have completed 4 developments this year, for primary developments: Ultron, Digistics and Imperial in SA, and DHL in the UK. All fantastic developments that will be within the Equites family, I think, for many, many years to come. More importantly, we've bolstered a relationship, with Ultron, which hopefully, an unbelievably successful organization, which will see significant growth in the years to come. We believe in SA, and our team and their team worked exceptionally well together, and we'd like to think that as opportunities potentially arise, that we certainly will be considered very seriously as their real estate partner. Over and above that, Digistics, it's not the first development we do with them, and the executive team and the operational team at Digistics and my team here at Equites have built a really, really strong relationship, and we've done fantastic business together, and obviously very proud to include a new facility into the mix. In terms of what we're doing, I mean, obviously EDGE certification has become a buzzword in our office. The greening of all our new builds is been a part of the course for a few years now. I think Rian will talk to it in a bit more detail in terms of what we're doing with our existing portfolio, and some interesting developments in terms of that. And then obviously what we're doing 7 years in, this is our 7th year. I think what we've done is we've built a massive degree of credibility in the marketplace. We've built a massive degree of trust, not only from shareholders, I think, but also from potential clients. And we've gone that extra mile for people. We've really tried to share our IP, our knowledge, both from the South African market, but also from the UK market with our clients. And I think our clients have really benefited from that. And I think once they've sort of bedded into their facilities, they've noticed marked improvements in their efficiencies, which sometimes are very difficult to explain and extrapolate pre the building being completed. Just a couple of pictures. This is the Ultron facility and what it looks like inside. And then Digistics facility. It's actually quite interesting to look at this one. As you'll see, we've removed all essences of bricks, plasters and paints on the outsides of our buildings. We use cladding, glass and the like. And this really is to ensure that we reduce maintenance. I mean, we've really had a drive in our development thinking to ensure that whilst our leases are fully repairing and maintaining, maintenance costs remain a grudge for your tenants, no matter what. And ultimately, we are producing product which will never eliminate maintenance. Maintenance is a must, but we are reducing the quantum of maintenance and the quantum of money needed to be spent on our buildings as a consequence of building them to the most exacting standards up front. You'll notice on the Imperial building there, obviously, all the solar panels as well, which obviously is another fantastic thing that Equites does is we put the solar panels on, and the power that comes from them is actually given to our tenants as part of the mix. Anyway, that's me done for now. I'm going to hand over to Rian, and Rian's going to take us through the property fundamentals and really what's made Equites tick in the last year.
Thank you, Andrea. When you look at the commentary that came out this morning on the financial statements, it's sometimes not obvious what the reasons are why we've produced 7 consecutive excellent sets of results. I think it's quite simple. We have focused for the last 7 years on building a business that creates predictable and sustainable income. And we've done that through developing and owning quality logistics facilities in proven nodes led to financially very strong tenant on long-dated leases. Again, very simple, but it has taken a lot of focus, discipline, and intelligent capital allocation to build a portfolio of this quality. Now, when you look at the fundamentals, again, when you look back over the past 7 years, you would see that every single year we've improved on them. And at the moment, our weighted average lease expiry profile that Andrea referred to at 15.4% has received a major boost through this Shoprite Checkers transaction and also the two or three developments that we've done in the UK over the last couple of years. We've grown our income-producing GLA under management by 64%, and our portfolio value has increased by 4.4 billion to just shy of 20 billion, which is an increase of 30% growth from the previous financial period. Now, you know that we started with 1 billion not so long ago, and under 7 years, we've taken this number up to nearly 20 billion. And I think very importantly, again, we've achieved this growth whilst continuously also improved the property fundamentals. And that's been the challenge, and that will continue to be the challenge, and we will not waver from that commitment. The weighted average contractual escalations in South Africa is around 6.4%. As you know, in the UK, we've got rent reviews every 5 years, when we should, in the current environment, receive significant increases. And then finally, our tenant mix is made up of 95% A-grade tenants. The combination of the WALE of 15.4% and coupled with the A-grade tenants of that percentage is what really gives us the predictability and sustainability of income, which underpins our performance and secures the continuous growth of our financial distributions. The next slide talks to the split in the portfolio and how it's evolved over the last 12 months. Interestingly, for those that are negative South Africa, our South African logistic portion has grown from 44% to 54%, firstly due to the sizable Shoprite transaction. And we've also had a very, very successful development year over the past 12 months with several significant developments that Andrea has referred to having been completed in the Gauteng area. No, I'm not. Apologies for that. As for the UK, you'll see when the slide come back now, the UK logistics portfolio makes up 28% of our portfolio. It's down from 38 last year. It's the next one, Mel. Thank you. It is down because of the sale of our 2 Stoke assets. However, as Andreas alluded to several new initiatives in the UK, I expect our UK portfolio to make up a larger part of our portfolio by the end of FY22, of the £100 million developments in Peterborough, as well as in Hoylands, where we'll be developing for Amazon and Hermes. Our total exposure to land remains consistent at 11%. I think we've continuously and consistently communicated that one of our focus areas is the development of new product. And to be able to do that, we need access to quality nodes consisting of zoned land. So this will remain a big part of our focus, especially in the UK, where, as Andrea indicated, it has become well-nigh impossible to acquire on the open market, and we're very fortunate through our joint venture partners to have access to premium quality land, and we will be rolling out some new developments over the next 12 months. Ongoing developments make up about 6% of the portfolio, and we've continued to reduce the non-core assets in our portfolio. We still have a couple of assets that are not specialist logistic facilities, and as the opportunities arise, we will be recycling these assets out of our portfolio. The next slide deals with the rental collection over the past 12 months. You will note that we have collected 99.3% and 100% of rentals invoiced for the year in SA and UK respectively. Fortunately, 100% of our tenants are now fully operational, and we've had no tenant failures over the last 12 months, which again speaks to the quality of our portfolio and the financial stability of our tenants. We've granted cash flow relief to several of our tenants through deferred payments. You will see from this slide that we've collected about 50% of the deferred rentals already, and we'll be collecting the major portion in the current financial year, with the remaining 18% of the deferred rentals being collected in the subsequent financial year. Our tenants have appreciated our assistance, and in this period through the pandemic, we've also grown closer to them because it has been very important to continuously liaise with them and to understand their realities, and also to see how we can be of assistance. The next slide again talks to the predictability of our income. We're in the fortunate position that more than 64% of our leases by revenue expire beyond 5 years. Now that creates a unique opportunity. Only 10% of our leases by revenue expire in the next 2 financial years. So one can really focus and spend time on those leases that are expiring. One can really communicate with your tenants to see what the requirements are. Often tenants outgrow space. With our land availability and development acumen, we can then put them in a new facility. But it really puts us in a position where we're not under pressure, where we can deal from a position of strength and make informed decisions on lease renewals and decisions with our clients. Again, the well coupled with the 95% A-grade tenants really are what underpins the performance of our portfolio. We've introduced 2 new initiatives in our asset and property management departments. Now, Andreas alluded to the fact that ESG has become a major focus area for most multinationals, and certainly for Equites as well. As a developer, we have over the past 2-3 years already started developing to the highest environmental standards with EDGE certification. So the real opportunity lies in looking at our existing portfolio, which includes some older facilities and also mainly facilities acquired from third parties. We have therefore launched sustainability audits by external sustainability experts in respect of each and every one of our properties in our South African portfolio. The first results have been very well received, and we see ample opportunity to implement further important sustainability initiatives, especially relating to energy and water, which will further improve the efficiency of those buildings and also the ESG rating of our portfolio. We've also been very surprised of how positively this initiative has been received. Most of our tenants are under pressure from their shareholders to also improve their credentials, and the indications have been that they're more than willing to consider investment opportunities to ensure more efficiencies and also to up their ESG scores. In the final initiative, now we always refer to the fact that our leases are all triple net, and the impression is sometimes created that we leave everything to our tenants and we can sit back and collect the rent. Unfortunately, it's not that simple. To monitor and manage these lease agreements and ensuring that our tenants actually do all the maintenance is something that keeps our property management team extremely busy. Also, we've seen over the last couple of years that due to adverse economic conditions, many of our tenants have scaled back in their maintenance departments, and they're becoming more reliant on assistance from landlords in ensuring that they do the annual repair and maintenance work. We've, in January, launched an initiative which we call the Assistance Maintenance Program, in terms of which we've gotten our preferred service providers to provide costings and draft service level agreements to each one of our tenants to assist them to have a better understanding of what type of maintenance work needs to be undertaken every year, and also to make sure that what they are doing at the property is cost effective and ensures the longevity of the property. This again has been very well received, and we are working closely with our tenants to ensure that their properties are well maintained. Multinationals are always nervous for exorbitant reinstatement costs at the end of the lease, and we also prefer to have a relationship with them that ensures that spending is continuous over the life cycle of the lease, and we don't have surprises at the end. So the sustainability audit and assisted maintenance programs have now become standard to our property management department, and it's something which we feel will add a lot of value to our property portfolio. That's all for me. Leila, now for the interesting part.
Thank you. Thanks, Rian. Thank you very much, Rian. Okay, so let's start with probably the most important number. Andrea has already alluded to it, but in a very challenging year, we've grown distribution per share by 2.4%. So we're declaring 155 cents per share compared to 151.39 at Feb 20. A little bit later on, we'll go into the DPS bridge, which explains line for line what resulted in this growth year on year. Our NAV per share is slightly down. There's a 1.7% decrease, so we've moved from 17.55 to 17.25, and this is largely related to the decrease in the valuations of the South African portfolio. Our LTV is at 31.2%. We feel that this is an incredibly conservative LTV, and coupled with our strong liquidity, we feel that this puts us in a very strong financial position. Our weighted average debt maturity is at 3 years. Again, we'll touch on this in the Treasury Management section. And at year end, we had R1 billion in cash and undrawn facilities. So if we look at our distribution statement, the first line item is the growth in net property related income. So there was a 20% growth year on year, and a large portion of that was supported by the growth in like-for-like South African property income. There was growth in like-for-like South African property income of 6.7%. The remainder of the growth related to the acquisition of the Shoprite portfolio, which is a 3.2 billion rand portfolio which we added to our portfolio, as well as the completion of our developments, which Andrea chatted to, both in South Africa and the UK. So overall, we feel that that's a very strong increase in net property-related income. Our net finance cost has decreased year on year. This is partially related to the decrease in the repo rate of 300 bips over the period. But if you remember our hedging policy, we were fairly hedged at Feb 20. And so we weren't able to capture the full 300 basis points decrease, but on any marginal facilities, that was definitely captured. We also had an increase in finance income. So in the prior year, it was 6 million rand. In the current year, it was 16 million rand. And that was mainly as a result of the liquidity measures which we took in the early onset of the COVID pandemic, where we invested additional proceeds in money market and call accounts. Then if you look at our shares outstanding, we successfully concluded an accelerated book build, which was effective on the 3rd of March 2020, and we had 2 very well-subscribed drips during the year, which gave rise to the increase in the shares outstanding. We love bridges, so to describe the movement or to explain the growth in the distribution per share, we start off with like-for-like growth of 6.7% in the South African portfolio, which contributed 4% to the growth in DPS year on year. From a UK perspective, the UK doesn't have annual escalations. There are rent reviews every 5 years. So there was no growth in the like-for-like UK portfolio on a pound basis. However, due to our progressive hedging policy, as well as the depreciation of the rand, this contributed 1.7% to the growth in DPS. Then if you look at the negative movements, those total 3.2%. Firstly, there was a temporary vacancy in the portfolio, which has subsequently been let to a multinational on a 5-year lease, which commences now. It's already commenced. We ceased the capitalization of interest for 2 months. We follow IFRS to the T, and where development activities had ceased in South Africa, we ceased the capitalization of interest on our developments for 2 months. And then we have negative 1%, which was all of our liquidity measures which we had taken or undertaken during COVID to ensure liquidity. So it was investing surplus funds in money market and call, as well as our other expenses associated with COVID. And that really takes us to the 2.4% growth year on year. Okay, in terms of our financial position, I guess the most noteworthy line is the 4.4 billion rand increase in our property portfolio. Rian has already spoken about this, but the largest driver was really the acquisition of the 3 distribution centres let to Shoprite with a total value of 3.2 billion rand. In addition to that, our property valuations in the UK increased by 9.7%. There was some detraction as a result of the decline in valuations on the South African portfolio, but then we also had the new developments which were brought online both in South Africa and the UK. And combined, that explains the 4.4 billion rand increase in our property portfolio year on year. For the first time ever, we have a line item called trading properties. This relates to a piece of land in Basingstoke. In this particular instance, we feel that we'll be disposing of the piece of land and signing a development agreement. We are in the final stages of negotiation of this particular contract, and details will be brought to the market via SENS in due course. Our cash equivalents were substantial at period end. If you remember, we transferred the 2 Stoke assets on the 26th of February, and those proceeds were still in our bank accounts over that weekend. So that was the predominant reason for the increase in cash and cash equivalents over the period. And then again, equity attributable to shareholders, it was the accelerated book builds as well as the 2 drips. Another bridge, if you look at where we started the year at 1755, basically the decline in the value of the South African portfolio was offset largely by the increase in the value of the UK portfolio. So if you look at that, because of the weighting of the South African portfolio, it still slightly outweighs the increase in valuations in the UK, but on a net basis, that contributed to a 5% decline in the NAV year on year, NAV per share year on year. If you look at the 155 net of the 151, that was our operating income for the period, less the dividend. Then, for the first time ever, we recognized deferred tax liabilities on fair value movements in the UK. This was as a consequence of us changing from the non-resident landlord scheme to being corporation income taxpayers. This was a mandatory change in terms of UK tax adjustment, or the change in UK tax legislation for the period. And then there were some other adjustments which take us to the NAV per share of 1725 at period end. The last bridge, our LTV, we wanted to explain how we arrived from an LTV. We started the period at 26.2% and we've ended the period at 31.2%. Very importantly, that 26.2% includes the proceeds from the accelerated book build, which was effective on the 3rd of March. So if you think about the majority of our expansion during the year, that was funded through debt, through our debt capacity. So if you look at it, the ShopRite acquisition increased the loan to value by 1.8%. We had 2 very well subscribed DRIPs, which decreased the LTV by 2.3%. The net fair value movements were negative in this period, which again increased the LTV by 0.5% or 50 bips. Then our development activity, both in South Africa and the UK, increased our LTV on a combined basis by 8.6%. Then lastly, right at the end of the period, we disposed of 2 assets to Blackstone, which was testament to our ability to recycle capital at above book values. Andrea mentioned earlier, we recycled these at 6%, at a 6% premium to our book values, which resulted in a 2.9% decrease in our LTV. And that's basically how we arrived at our LTV of 31.2%. Okay, valuations are always a topical issue. And if you remember, about 2 years ago, we made a very concerted effort to refine our policy in terms of valuations. We now value each asset externally at least once every 18 months. What we also do is, for reasonability, we test all of our internal valuations to the external valuation assumptions. We've also increased our panel of external valuers and now have a panel of 5 valuers who value our properties both in South Africa and the UK. On a like-for-like basis, in South Africa, the property valuations decreased by 5.2%. And this is primarily as a result of COVID uncertainty and conservatism baked into these valuations. In the UK, the property valuations on a like-for-like basis or on a pound basis increased by 5%, and on a ZAR basis, these increased by 9.7%. Furthermore, what we do to test the reasonability of our valuations is we compare the values on a rand per square meter basis. Now, if you look at our table, modern distribution centres at 8,800 rand per square meter, given the spec we are currently building, land plus construction values, I mean, we'd be hard pressed to redevelop these at a similar value. And so we're very confident that our valuations are a fair reflection of economic reality, and there's a fair amount of conservatism baked into these. Okay, so we've put up a slide on capitalization of interest. We just want to reiterate our policy. We capitalize interest in line with IFRS. We follow IAS 23. And as I've previously mentioned, for the 2 months of the year where there were no development activities undertaken, we had ceased capitalization, again in line with IFRS. Borrowing costs are capitalized on all qualifying assets, including land, where there are sufficient development activities which are being undertaken on those parcels of land. We feel that the average holding time for these parcels of land are between 3 and 5 years. And what we've seen in the recent months is definitely an uptake or an uptick in the demand for development activity in South Africa. And we hope that by our next reporting period, we'd be able to report on even more developments which are currently being undertaken on our land parcels. Okay, so if we look at Treasury Management, I think I've touched on a lot of these, but just to reiterate, our loan to value of 31.2% is very conservative. We feel that this provides us with sufficient runway to execute our development pipeline. What is noteworthy is we also have 7.4 billion rand of unencumbered assets, which provide us with a fair amount of flexibility to further raise debt facilities in order to execute our development and potential acquisition pipeline. In terms of our debt maturity is 3 years. We've been very strategic about the renegotiation of facilities. We're trying to maximize both our secured and unsecured assets so that we really have an optimal mix of both secured and unsecured facilities between traditional finance providers as well as the debt capital markets. We have also bolstered our relationships with many of the key banks and fixed income investors over the past couple of months, and we really will look to renegotiate many of our facilities in the near future. If we look at the cost of debt has come down by about 75 basis points year on year. This is primarily due to the decrease in the repo rate. But again, as I said, we haven't been able to fully benefit from this due to our hedging position in the prior period. And then our undrawn facilities, we have at Feb 21, we had 1 billion rand of cash and undrawn facilities, which again puts us in a very favorable liquidity position. So I've briefly chatted to our position with banks and fixed income investors. We've expanded the pool of our of the counterparties that we deal with. We now have a total of 8 debt providers. That excludes all of our fixed income providers. And we're very confident that this positive relationship we have with the banks and with other financial institutions will continue. It's definitely in our interaction with them, it's clear that we are very well regarded in the debt capital markets right now, and we hope to continue to execute on our strategy to both increase the sources of our debt funding and to further reduce the cost of debt. Andrea alluded to it earlier, but one of our proudest achievements, or one of our greatest achievements during the year, was the conclusion of the sustainability-linked loan with Standard Bank. Was the first of its kind in Africa with a REIT counterparty, and we're looking for further innovation in the sector and definitely in the debt capital markets to see how we can further improve our offering. To touch on our hedging policies, I think that our hedging policies are well explained in our financial statements. There's a fair amount of detail, but if we look at hedging our interest rate exposure, our policy says that we should hedge 80% of our outstanding term loans and 70% of our outstanding term loans plus capital commitments. In a low interest rate environment, interest rate hedges are particularly expensive, and so we're monitoring the market very carefully to determine the right point at where we can top up our hedging levels. But where we're at right now, at 96.5% of outstanding term balances, we're very comfortable with this position. Okay. If we look at the hedge of our net investment in a foreign operation, we use cross-currency swaps to hedge our net investment in foreign operations. We feel that this is an effective and efficient way of hedging this net investment. What we have done over the period, as our asset base in the UK has grown, we've reduced the utilization of our cross-currency swaps from 29% at Feb 20 to 25.2% at Feb 21. We've always stated that when the opportunity becomes available to fund our developments in country, we will always look to do so. With an asset base of 366 million now in the UK, we feel that we've established a strong presence amongst financial institutions and banks in the UK, and we'll look to continuously improve our in-country funding of our UK portfolio. Hedging Forex, we have a progressing hedging policy whereby our strategic imperative is to provide short-term certainty in terms of our UK distributable earnings, but to provide investors with exposure to a depreciating rand in the longer term. And that's why we have a progressive policy which reduces, our hedging levels reduce as we go further out into the future. At the bucket for 31 August, you'll note that we're slightly overhedged at 106%. That's because when we entered into these hedges, we still had the income from the 2 Stoke properties, which were disposed at 26 Feb 2021. We're comfortable at that level because if you look at the exchange rates, they're still fairly in the money at this point in time. Okay, and that's it for me on from a finance point of view. I would just, before we move on to ESG, I would just like to point out that we always try to put as much disclosure as possible into our financial statements. This year, I think we've done an exceptional job at once again putting a significant amount of disclosure in our financial statements, and we'd like you to look through them and engage with us should you have any questions. Okay, Andrea and Rian both mentioned that sustainability is becoming a part of our fiber. It is ingrained in what we do. For the second time this year, we were rated by Sustainalytics, who's a global sustainability rating agency. We particularly focus on the management score, and if you look at it, we've managed to improve our management score from 33.5% to 35.5, which was a 6% increase year on year. We did particularly well in areas such as governance, board composition, and our policies with regards to social and environmental aspects. Our sustainability framework is largely aligned to the United Nations Sustainable Development Goals. There are 17 of them, and we've isolated the areas in which we feel we can make the most impact. I'd like to touch on a few initiatives which we've embarked on during the year. I'm going to start with the formation of our Sustainability Steerco. We've put together a group of individuals in the organization from various facets who deal with elements of sustainability from a development, property management, legal, and finance point of view. This ensures that we have a combined and strategic approach to sustainability, which encompasses all the elements of our business. Rian touched on sustainability audits at our properties. We feel that this is an important part of our responsibility as landlords. We'd like our tenants to understand their footprint on the environment, and many of them have been more than willing to embark or to walk this journey with us. As Andrea mentioned, we're at the cutting edge of developments, and all of our new builds are developed to be EDGE certification ready. All of our new builds that we have completed have already received their EDGE certificates. On all of our projects, we engage with the community to ensure that the community is involved in our developments, and as far as possible, we employ members of local communities on our development sites. We have reviewed all of our ESG policies, and our main focus is to ensure that they are aligned to global best practice standards. And then lastly, a cause which is quite close to our hearts, we've launched a new program, an incubator program called AMPCOR, which helps to incubate SMMEs in property-related services. This has been launched in our Gauteng office, and we hope to roll this out to the Western Cape. Of course, this is in conjunction with our existing SMME, or our enterprise development partner, Damon & Sons, who has been incredibly instrumental in a lot of the developments we've done in the Western Cape over the last few years. So to sum it up, we really feel that sustainability has become ingrained in our very fiber. We approach it from every element of our company, in our buildings, in our properties, in what we do, and we'd like to believe that this will continue to be a key focus area for us going forward. Thank you. Oh, sorry.
I'm back. Welcome, guys. And I'm just now going to really come up for 2 seconds and introduce our Newland JV partners. We have Graham, David, Ashley, and Simon on the line, and I'm going to hand over to the team, and they've got some very exciting developments to talk us through. Lady. Apologies for a bit of technicals. Are we getting there, guys? We just sort of getting through the process. Zoom is not working. We're trying to get the guys unmuted in the UK. They're currently on mute. Are you coming through, guys? It worked earlier, honestly, everybody. Okay, there you are. Perfect.
Okay, sorry about that, guys. It was just a sort of minor technical glitch. I think everybody can now hear us okay. So apologies for that. So yeah, Andrea, thank you for that introduction. We're going to talk a little bit about the UK market. We're then just going to touch on our 3 active schemes at Barnsley, Basingstoke and Peterborough. And then we're going to wrap up just talking a little bit about the sort of pipeline in the UK before we go into a Q&A session. So just talking a little bit about the UK market. Andrea touched on this earlier, but if I just elaborate a few sort of important points. We've seen a record year in the last 12 months of take-up at about 51 million square feet. So despite the pandemic, the levels of take-up in the last 12 months have been sort of quite extraordinary. And I think it's a well-known fact now that I think the sort of pandemic has actually sort of been beneficial for our sector. The rise in internet sales was sort of continuing at a steady rate pre-pandemic, but the pandemic has really accelerated the growth in the online sector to a point where we've seen a huge take-up in the UK market. About 33% of all sales now in the UK are done online. And I think there's a general sort of perception that that's still got quite a bit of growth to sort of go through over the next sort of few years. A lot of people talking about that hitting 50% in the next few years, which is likely to continue to sort of feed through to future demand. So we're already seeing strong signals that the market for this year is heading towards a record level as well, and hopefully beyond. One of the first sort of graphs that you can see in front of you, hopefully, is really just showing where that take-up has been. And the three dominant sectors that you can see there on the right-hand side of the UK, that really represents the core markets that we operate in. So it's the East Midlands, where our scheme at Peterborough is, the Yorkshire market, where our scheme at Barnsley is located, and then also the Southeast market, where our scheme in Basingstoke is located. And what we're seeing, particularly in these regions, is some strong rental growth. And that's partly driven down to the sort of the supply and demand dynamic. So there's been a lot of demand, but the UK continues to be constrained by supply. And one of the biggest factors, which we'll come on and talk about in the pipeline slide, is the barriers to entry in the UK. So it's cash hungry in terms of taking sites through planning, but also the skill set and scarcity of land, particularly the complicated process that we have to go through in the UK to secure planning consent. And that is likely to continue and probably exacerbate the supply dynamics. So we believe that will continue to sort of feed through to strong rental growth, particularly in those sort of core subsectors. The other chart on this slide here is really showing take-up by sector, and probably not a great surprise to see that the two sort of dominant subsectors is the traditional distribution sector, the 3PL sector, but also the online sector. And then within the online retail sector, we're seeing huge demand. And I think Andrea touched earlier on the Amazon effect. Last year it's widely believed that 25% of take-up was by Amazon. But if you take out 25% from 51 million, that is still a very strong sub-market. So we're seeing a lot of requirements from other online operators. The traditional 3PL distribution market remains strong. Some of the food guys are starting to come back into the sector. And then the post and parcel sector that sort of feeds into the online sector is starting to see really, really strong growth as well. So if we perhaps now just turn to our three assets that we want to talk to you about, three schemes where we're active. So if we can go to the next slide, please. So the first scheme is Barnsley. This slide is just showing you where the scheme is located. The slide that you can see there now, we move on to the site plan. You can see the Hermes Unit, and then on plot 2, that's our sort of phase 2 scheme that we have planning for. So the Hermes Unit, this is a scheme that we're very excited about. It's our first major development to come through the Newlands Equites joint venture. We signed this deal up last year, got planning and went unconditional and started on site in November last year. So we're now sort of well advanced on site. Hopefully you guys have seen some of the images of that development taking place. In fact, there we are, there's some there. So you can see the earthworks that we've done on site. There was a lot of earthworks involved in this site to get the levels to create the plateau for the building. It's a very long, narrow building, which is traditional in these cross-dock parcel hubs. The building's 340,000 square feet, and it's on track for practical completion in February 22. You can see the steel frame going up there. We're actually on track to hand over the first phase at the end of June to the German fit-out contractor who comes in and takes over the first third of the building whilst we're still finishing off the frame and cladding of the rest of the building. And then they sort of follow our contractor along with their fit-out. So whilst PC isn't actually scheduled until February 22, there's a lot of work about to start happening on site with the fit-out. Plot 2, if we perhaps go back to the previous slide, if we can, you can see there at the bottom of the scheme, we have planning consent for up to 500,000 square feet there, and we're ready to sort of take development forward towards the end of this year. The earthworks is just sort of being finished off on that plot, so we can start on site towards the end of this year. We've started marketing this scheme, and actually we do have a lot of interest in plot 2 already. We're sort of talking to people now about terms, so we're actually hopeful that in the next sort of few months we will have a deal there that we'll be able to announce to the market. So we're very excited about Barnsley. It's going extremely well. If I now hand you over to Simon, Simon's just going to talk you through our schemes at Peterborough and Basingstoke.
Thanks, Graham. The Amazon development at Peterborough Gateway sits on a site of 17 acres and is located on the A1M motorway, approximately an hour north of London. The Amazon plot is the final of a very established wider scheme, which totals 200 acres and approximately 4 million square feet. The Amazon facility was granted planning consent in December of last year, and we started on site 6 weeks ago, with the building due for completion in July of this year, with the construction programme running according to time and budget. The facility itself is 142,000 square feet. It's a low density bespoke last mile parcel delivery unit, which will operate a fully electrical delivery fleet from the building. In terms of the actual lease terms that have been agreed with Amazon, it's a 15-year full repairing and insuring lease with a rent at 2.5 times open market value, which reflects the site density and the actual level of construction cost of this building, with fixed uplifts throughout the lease term. If you just move on to, there's some updated imagery of the building. That's literally, I think, early part of last week. In terms of Basingstoke, the site at Basingstoke is located at junction 7 of the M3. It's 70 acres in total, with the M3 being the main arterial route that runs from the southwest of London. On the 7th of April this year, we received full permission for a 2.4 million square foot multi-storey facility, which is to be delivered for a major online retailer, which is to be developed on 42 acres of the wider 70-acre site. So the building that we have now permission for will approximately sit on 2/3 of the site. We anticipate the Section 106 agreement being signed with the local authority in the next 2 weeks, which would then lead us to a position where we become unconditional end of June, early July of this year, which would lead to a start on site dates with construction, with then completion of the building and all related on-site and off-site infrastructure works being due September of next year. In terms of the structure of the deal, the development is to be delivered on a freehold basis, which encompasses an initial land purchase by the occupier, with them then funding the full construction process on a monthly basis through to completion of the building. And in terms of the balance of the land, we are now close to agreeing a development with a single occupier on the balance on the balance of all the land, which would take out the whole of the Basingstoke Gateway site. That's on a leasehold basis, and we're anticipating submitting a full application for that building in circa 4 to 6 weeks' time.
Thanks, Simon. Shall I take us through the future opportunities? So I think this is the first time that we've put on one page all of the current sites that we've got in the Equites Newlands joint venture. So we've got 11 sites there. Clearly, we've got some exciting on-site works at Hoyland and Basingstoke, and the further plots that they bring with them. But we've actually got some positive news in respect of another couple of sites. So we've got planning permission for our scheme at Rugby, which is 285,000 square foot, probably 2 units there. Planning has been received, and we're just working on the drawdown arrangements for the land in order that we can start construction in quarter 4 2021. That site is going to be marketed over the balance of the year, but once it's opened up, I'm sure, given its proximity and central to the UK, that site will go very quickly. Similarly, we're going through to planning on the 2nd of June, so next month, at our East Midlands Interchange building at Junction 24 on the M1. That's for 850,000 square foot, 79,000 square metres. That application is going in with officers' recommendations for approval, and we're already underway with a couple of opportunities for discussions on pre-lets. So again, I would envisage that we're building out a part of that site early next year. So we've, in all, we've got currently in the hopper, as I call it, we've got 11 sites delivering in excess of 15 million square foot. That's probably a sort of 8 to 10 year pipeline in terms of land. So in terms of what that's going to deliver in the next 3 to 5 years, it's sort of gross development value of 800 million sterling. That will be through a mixture of leasehold deals with pre-lets to be put onto the Equites balance sheet, as well as freehold stroke turnkey deals that will generate profit and fundamental cash flow to enable us to open up land and infrastructure on all of these sites. So through a mixture of hold and sell, we'll be generating cash to fund that GDV pipeline. But what I think is important is that these sites, we've been going almost 3 years now as Newlands with an JV. These sites range from 250,000 square foot to some of them being 3 million square foot. Some of them are probably 4 or 5 years out with planning. So it is definitely a 10-year pipeline. And what we're keen to do is to maintain the sort of putting land into the system, given the gestation period, in order that we can keep the sort of 3 to 4 million square foot of construction each year. We don't want it to peak and then come back down. So trying to maintain that pipeline by putting land in constantly as we develop it through. And in order to do that, we've recognised that we needed to invest in our team. So we've brought in a 50% further people. So from when we started, so we're now a team of 16, and we've got another offer out to a further developer. So we'll have 6 people directly involved in development and pre-lets and bringing land through the planning system on top of the construction, finance and office support staff. So it's becoming quite a significant team of probably going to peak out around 20 people in probably another 18 months' time. So that brings me to sort of giving you a snapshot of the opportunity that we've got. And I'll hand over back to Andrea.
Thank you, Ashley. Thanks, Graham and Simon. And I hope that gives a bit more colour to something that obviously, as an Equites team, we've been very excited with. And we've talked quite a lot about in the last couple of years. To add to that, we have a South African business which is also doing extremely well. So it brings me on to our prospects, and let's have a look at that. I mean, the first one is that we are pretty confident that we'll probably secure about 5 pre-lets within the South African market within the next 12 to 18 months. We currently have 1 pre-let already on the go, and the plans have been submitted to council, and hopefully we'll be on site there in June. There are a few others which are awaiting final signature. Like all these things, they always take time. We're going to continue to look to source high quality assets in SA, and we are engaging with the open market. Our exacting standards obviously does limit what we can and can't buy, but notwithstanding that, our reputation in the market for deliverability, for working quickly, working efficiently, and has obviously comes before us, and as a consequence, a lot of potential vendors look at us as definitely a prime acquirer if they are sellers. In the UK, I mean, obviously the team have just spoken to Hermes and Amazon, and there is a pre-let obviously going on to Basingstoke, which we will be looking not to keep. That one will be done on a what we call turnkey in South Africa and what they call freehold in the UK. I mean, Leila and our finance team will continue to put us under massive pressure to ensure that we don't overstep our reach, and we will continue always to maintain a conservative balance sheet. We certainly have no intention of stopping to distribute 100% of our earnings, and we obviously have the good fortune of having an asset base and a sector that we operate in which affords us the ability to keep on doing so. So that is one thing that, you know, our board reaffirmed in our meetings in the last week, that the intention is to continue to distribute 100%. And then the final element, obviously, in terms of our key points of focus is finding the correct levels of capital and the various sources. And this probably brings us on to the next slide, which is, you know, something I think we touched on pre-close in February with you guys, and the different things that as a team that we are exploring. And obviously we are looking at potential of listing the business offshore or dual listing. These two elements obviously will require, we believe, the portfolio to be substantially larger before they can be really considered. But notwithstanding that, we are engaging with the various parties to see how this could be done and where it could make sense. Over and above that, something we communicated earlier as well was the sale of a minority stake in our portfolio. And this really is a twofold thing. Is firstly, obviously, is to try and crystallize and cement some of the exuberant pricing that's in the market at the moment, and coupled with that, obviously release that equity back into this development pipeline, which we, as you can see from the Newlands presentation, is going to be pretty substantial over the coming years. The opportunity remains that we potentially could dispose of UK properties. At the moment, there's no intention of doing so in the short term, but because of the liquidity of the UK market and the speed of execution, which was shown, for instance, by Blackstone, I think we went through the Christmas period, and from heads of terms to exchange, I think it was a 6-week period. So, you know, that really talks volumes to the scale of the UK market, the liquidity of the UK market, and the quantum of money available to buy these exacting assets. The other opportunity, obviously, is to raise money on the JSE from our existing shareholders. You know, it always comes down to, at the end of the day, the value at which we can raise. And we, as a management team, will continue to explore all avenues, and we will ensure that we make the right decision for our shareholders. The one that will extract the most value for them and allow us to continue feeding this machine, which really has got some great years ahead. And then the final element, which I think is a little sort of massive bonus for us, and that is the turnkey opportunities in the UK, and the value upside that is afforded in the development process in the UK, and the ability that we can then take that profit and reinvest it in further schemes, which obviously, with the fair value adjustments that we will recognise on completion of assets that we keep, the benefit of those things will come through and will filter through into our NAV, but also into our distribution, so giving us a fantastic total return. In conclusion, and it gives me great pleasure, obviously, to give some guidance for the year ahead, and obviously after some great debate with our board in the last week and the various committees, I mean, I think the management team is very comfortable with giving guidance of distribution growth of between 5 and 6% for the year to Feb 2022. Over and above that, we will also be looking to give a total return which will be in double digits as a consequence of the positive NAV growth that we will return to in the upcoming year. So all in all, I think a really, really pleasing set of results to have come out of the year that we've come out of and present these numbers gives me a massive sense of pride. Obviously, I want to thank my two co-executives. I mean, Leila and Rian, you know, as a team, we've really operated extremely well under massive pressure in the last year. And I'm really grateful for the incredible work that they've done. But not just them. I mean, even, you know, the rest of the team. You know, we've got a senior management team at the moment that assists all of the executives, which really have come to the fore. You know, and we have Vainant that's joined us, we have Warren that's joined us, we have Tashmika and Nazreen in the finance team as well, who have really performed admirably in last year's audit, you know, which was under lockdown, and in this year's audit as well. I mean, the work that they've all put in is incredible. You know, the development team with Jean, Stephen, Pilo, and Lloyd have done exceptional work under very trying circumstances. You can imagine, you know, we were locked down on construction for 2 months, and Pumi also joined us. Apologies, and Pumi in Cape Town. But it's been a challenging year for them, and they've executed admirably, and under massive pressure from clients who still expect everything to be delivered yesterday. On the asset management side, you know, we got Vota and Todd, who reporting into Rian, have really taken a lot of pressure off Rian, and have really assisted him in that role. And then obviously up in Johannesburg, we've got a Kua that's really been tireless in a pursuit of new business, and obviously also in maintaining the relationships with existing tenants, and has assisted Rian very ably up there. As for property management, the reality of it is that, you know, all the billing, all the assisted maintenance, I mean, Hilda's led the team, Z, Tanya, Gustav, and Tobogo up in Johannesburg as well, and Monique and Zianda also here in Cape Town. So, you know, an exceptional work ethic under very trying circumstances. You know, a lot of them have had to work from home in certain instances and all. And then finally, I just want to thank our board, our chairman, Leon Kamfer, always a guiding light for us, and obviously very great manager of the entire team and the rest of the team. So thank you to everybody, and we'll take some questions now. Okay. So Rian, let's hit us with some questions. What do we have?
Andre, the first question from James from Marsh. He asked the Newlands team, what has been the impact of Brexit on UK logistics, and what do you see the way forward, what the impact would be in the medium term?
So can we...
Yeah, I think, hi, it's David. Yeah, I think what you've sort of seen is companies wanting to control their supply chain. You know, I think people saw this coming, and if you know, a good example is Jaguar Land Rover. So last year they started development of a 3 million square foot complex in the West Midlands that was effectively going to bring all their supply chain back into one campus. So I think you know the economy generally probably hasn't been affected by Brexit as much as some people thought. And I think what we've probably seen, I think the main standout thing is people controlling their supply chain, or bringing their supply chain closer to home. So, you know, if you look at the UK market, you know, clearly the e-retailing bit had a huge effect. But I would say, you know, that's only part of the market. I think people sort of looking at their supply chain and sort of bringing that into modern buildings, and probably also the sustainability piece as well. You won't, I guess here is in a couple of years' time, you won't be taking diesel trucks into city centres. So that, again, sort of people really looking at the whole supply chain, the parcel business, etc. So, fundamentally, I would say a positive for our business.
The next question from Velzo. Given the tight yields, I understand Equites may dispose in the UK at the peak of the cycle and redeploy the proceeds into Newlands JV. What is earmarked for sale and at what value? Maybe Andrea?
Currently, there's nothing that's fundamentally earmarked for sale. We are and have been investigating the opportunity of selling a minority stake in the entire portfolio. And once you've added the Hermes and the Peterborough assets, which should be complete in this financial year, to the portfolio, and the fair value uplifts, that portfolio could comfortably be worth north of £460 million, and obviously fast approaching that mythical £500 million. But as we stand at the moment, there's nothing's for sale. But should the right opportunity to crystallise that value present itself, management would certainly look at it and take it to investment committee for consideration.
Thank you, Andrea. Leila, the next question I think is for you. It's from Daniel. What percentage of the South African portfolio was externally valued? And also, what drove SA valuations down? And how do you see the valuations going forward?
Okay, so I think it was a challenging year for valuations in South Africa. And part of it was driven by the uncertainty relating to COVID, which definitely impacted the assumption of market rentals and how these rentals would look in the terminal period. So I think that was part of what drove the decrease in valuations, as well as definitely an impact on the discount rate that was used in these valuations. So looking forward, I think a large degree of how this unfolds will depend on how the economy rebounds. I mean, global growth estimates are definitely looking up, but in South Africa, we obviously have our challenges ahead. So I think, Daniel, a lot of it will depend on what happens post-COVID, whether there are any second round effects. We think that our values are fairly conservative right now, and I don't see far more decline in the future. But again, it ultimately depends on what the economy does over the next 6 to 12 months. Just in terms of the percentage that was valued externally, so in our report, we have stated that 56% of the properties were valued externally at Feb 20. That was slightly skewed. South Africa, just over 60% of the South African portfolio was valued externally at Feb 2021.
Thank you. Thank you, Leila. Another one for our UK colleagues. Do you foresee tenant demand remaining strong in the medium term? And is it just e-retail driving demand? That's from Peter.
Yeah, okay, no, good question. We touched on this earlier. I think that the short answer is, yes. The growth in the e-retailing sector is widely viewed still to be sort of strong. I think I mentioned earlier in one of the slides that around about 33% of online sales, sales are done online in the UK. That's widely sort of viewed to be likely to go in excess of 50% in the next few years. So if you sort of compute that through to additional floor space, it's likely to be significant. Amazon still have huge growth plans. I think the parcel sector has got huge sort of growth plans to keep up with the online sector. I think Andrea touched on this earlier, that a lot of other retailers are playing catch up with not just Amazon, but some of the other retailers in the UK that are really at the forefront of e-retailing, like Next. They're guaranteeing parcels the next day, the next morning, and there's still a lot of retailers that need to play catch up on that. And the only way to do that is to get a network of warehousing. There's returns that come with the sort of e-retailing sector. A lot of retailers are now taking warehouse space just to deal with returns and repackage them. So I think there's a lot of growth still to come out of the e-retailing sector. But as David alluded to earlier, we are still seeing a lot of growth out of the traditional distribution sector, and that's partly, I think, coming to the sort of onshoring post-Brexit. There's definitely a bit of that going on. But we're seeing some of the other more traditional sectors starting to come back to life. We spoke to some of the traditional food retailers, your sort of Tesco's and the like. are definitely starting to look at their future plans. They've had a very busy year making their stores safe and making sure that they're keeping the sort of food supplies up to standard in the sort of height of the pandemic, and now sort of looking at the sort of portfolio. So I think we're pretty confident we're going to see a lot of growth from a number of corners of the market.
And I think you'll see sort of technology improve with the sort of apps of, how people buy goods, return goods. And, there's massive investment in that. So these companies, they have to deliver efficiently, because bluntly, if they don't, they'll be forced out of the market. So, I think we'll see a lot more of that in the next 2 or 3 years. And as I said earlier as well, I think the whole sustainability piece as well is going to have a big play in the next sort of 0 to 5 years as well. With battery operated vehicles, et cetera, and how you particularly deliver in urban areas.
We've got a lot of questions relating to the e-commerce surge in the UK. And maybe a last question for our UK colleagues is, do you think UK flagship malls can survive in the world where online goes beyond 50%? Do valuations for retail converge towards logistics last mile rentals? David from Fairtree's question.
Yeah, you're absolutely going to see a big realignment in retail here. I think the sort of large malls will probably survive, I think, although they'll look different places. I think it's more the traditional high streets that'll change. And I think the pendulum was swinging through over the last few years. Clearly, the last sort of 14 months has massively increased that. And I think you'll see the sort of prime spots will have to reinvent themselves in some way and will survive. I think your more traditional high streets are going to look different places in the next five years, but that's just going to evolve. And I think it's now in the sort of DNA of the British consumer that they will. The last 12 months has shown how easy it is to buy online, and I think bluntly I don't see that going backwards. So inevitably that'll just move forward, and it'll see a sort of realignment in the retail sector without any doubt. You sort of look at some of the casualties in some of the old big high street names, and that's just inevitable in the world we live today.
Thank you very much, David, for that. I think, Andrea, that wraps it up for today.
Fantastic. Everybody, well, thank you so much for joining us. And invariably, some of you will reach out to us in the coming days, and we are available for questions. And Jan, thank you to the team, and thank you to all the technicians that made this happen. We had a few challenges last night, but we finally got there, and thank you.